In the year 2000, Enron was the seventh largest company in America by revenue. Fortune magazine had just named it America's most innovative company for the sixth year in a row. Its stock traded at over $90 a share. Wall Street analysts almost universally rated it a buy. 1 year later, that stock was worth less than $1. 20,000 employees lost their jobs. Many lost their entire retirement savings because it was tied up in company stock they'd been encouraged to hold. It remains one of the largest bankruptcies in American history. The company hadn't been hit by a market crash or a natural disaster. It had been hiding billions of dollars in debt in plain sight, using accounting structures so complex that even some of its own board members didn't fully understand them. This is the story of Enron and the accounting trick that became the blueprint nearly every corporate fraud since has borrowed from in some form. Enron started as a fairly ordinary natural gas pipeline company, formed in 1985 from a merger. Through the 1990s, under CEO Kenneth Lay and later Jeffrey Skilling, it transformed itself into something much more ambitious, an energy trading company. Instead of just moving gas through pipelines, Enron began trading energy contracts the way an investment bank trades securities, buying, selling, and betting on future prices. This was a genuinely innovative business model, and for a while, it worked spectacularly. Enron pioneered energy trading markets that other companies later copied. Revenue exploded from about $10 billion in 1996 to over $100 billion by 2000. It became a Wall Street darling, and executives like Skilling were treated as visionaries reinventing how an entire industry worked. But there was a problem building underneath the growth. Many of Enron's trading deals were volatile and long-term, with profits that were uncertain and might not materialize for years. To keep the stock price climbing and satisfy Wall Street's demand for constant growth, Enron needed a way to make its earnings look smooth and its balance sheet look clean, regardless of what was actually happening underneath. Here's the part that made Enron different from a simple lie. It wasn't hiding losses in a vault. It was hiding them inside a maze of legally created shell companies called special purpose entities. Enron's CFO, Andrew Fastow, built and ran hundreds of these entities, with names like LJN and Shuko. On paper, they were separate companies that did business with Enron. In practice, Fastow and a small circle controlled them. Enron used them to do two things: move debt off Enron's own balance sheet so it wouldn't show up in official financial statements, and book projected future profits from long-term deals as if they were already real. Current earnings, a practice called mark-to-market accounting, pushed to its most aggressive interpretation. The effect was that Enron's public financial statements showed a healthy, profitable, growing company, while the actual financial risk and debt were tucked away in entities technically outside the company. Fastow personally made tens of millions of dollars from fees on these very entities. This meant the person responsible for protecting Enron's finances had a direct personal financial incentive to keep the scheme running. For years, this worked because Enron's outside auditor, Arthur Andersen, one of the 5 largest accounting firms in the world at the time, signed off on it. Wall Street analysts, for the most part, took the audited numbers at face value. The unraveling began in 2001, when a Fortune journalist named Bertha Coombs, followed shortly after by writer Bethany McLean, started asking a simple question almost nobody else had: exactly how does Enron make its money? The company's own executives struggled to give a clear answer. Around the same time, an Enron vice president named Sharon Watkins wrote an internal memo to Kenneth Lay warning that the company might, in her words, implode in a wave of accounting scandals. Her warning was largely brushed aside internally. But externally, scrutiny was building through the second half of 2001. In October 2001, Enron disclosed a massive quarterly loss and a reduction to shareholder equity tied directly to those off-balance sheet partnerships. That disclosure triggered an SEC inquiry, and within weeks, the picture investors had of Enron's finances began to fall apart in public. Enron was forced to restate years of earnings, revealing it had overstated profits and hidden roughly $600 million in debt through the shell entities. The stock, which had traded above $90 a year earlier, fell below $1. On December 2, 2001, Enron filed for bankruptcy, at the time the largest bankruptcy filing in U.S. history, Arthur Andersen, its auditor, was convicted of obstruction of justice for destroying Enron-related documents. That conviction was later overturned on appeal, but by then the firm had already collapsed, taking roughly 85,000 jobs with it worldwide. Jeffrey Skilling was convicted on multiple counts of fraud and served over a decade in federal prison. Andrew Fastow pleaded guilty and cooperated with prosecutors, serving about 6 years. Kenneth Lay was convicted as well, but died before sentencing. Here's what made Enron the template for so much that came after. Almost nothing about the scheme was, strictly speaking, illegal on its own. Special purpose entities are a legitimate accounting tool. Mark-to-market accounting is a legitimate method. Enron's genius, and its crime, was combining legal tools to obscure the truth from investors, auditors, and its own board. The mechanism repeats across nearly every case on this channel: financial complexity used not to manage risk, but to hide it from the very people whose job is to catch it. An audit that's supposed to be independent, run by a firm that also profits from keeping the client happy. Enron gave Congress and regulators the case study that led directly to the Sarbanes-Oxley Act of 2002, new rules on corporate accounting and auditor independence that still shape how public companies report their finances today. It's a rare case where the fraud rewired the system it broke. Next week, the German unicorn that told investors it had $2 billion sitting in a bank account, money that, when regulators finally checked, simply wasn't there. Subscribe so you don't miss it. Sources for this one are linked in the description.